When investors want professional management, diversification, and liquidity, all in one investment, they turn to investment companies. These are the collective vehicles that pool money from many investors and invest it in a portfolio of securities. They're organized under the Investment Company Act of 1940, which divides them into three main types: face amount certificate companies, unit investment trusts, and management companies. Face amount certificate companies are rare today. They issue debt-like certificates that promise a stated return at maturity. Unit investment trusts, or UITs, are unmanaged. Once the securities are selected, the portfolio stays fixed. Investors buy redeemable units, and the trust terminates on a set date. Then there are management companies, which may be either open-end or closed-end. And these are the focus of the exam and of most investors. An open-end company is what we call a mutual fund. It continuously offers new shares to the public, and it stands ready to redeem those shares at their net asset value, or NAV. A closed-end company, on the other hand, issues a fixed number of shares in a one-time public offering. After that, the shares trade on the secondary market, just like any stock, and prices are determined by supply and demand. For mutual funds, the pricing mechanism is clean and consistent. The AV per share equals total assets minus total liabilities divided by the number of shares outstanding. NAV equals the intrinsic value of each share, and it's calculated once per day, typically at 4 p.m. Eastern, after the markets close. The price an investor pays to buy shares in a mutual fund is called the public offering price, or POP. For funds with a sales charge, the relationship between NAV and POP is defined by this formula. Sales charge percentage equals POP minus NAV divided by POP. For example, if a fund has an NAV of $9.50 and a POP of $10, the sales charge is 5% because 50 cents divided by $10 equals 5%. The maximum allowable sales charge for mutual funds is 8.5% under FINRA rules, provided the fund offers both breakpoints and rights of accumulation. A breakpoint is a volume discount. The larger the investment, the lower the percentage sales charge. For example, if a fund offers breakpoints at $25,000, $50,000, and $100,000, and an investor puts in $48,000, the representative should always inform them that adding $2,000 more would reach the next breakpoint and lower their charge. Breakpoint sales violations occur when sales are deliberately structured to avoid reaching those discounts, a serious compliance issue. Investors can also qualify for a reduced sales charge through a letter of intent, or LOI, a written commitment to invest enough over a 13-month period to reach a breakpoint. While the LOI isn't binding, the fund holds shares in escrow to adjust the sales charge once the investment goal is met. There's also the right of accumulation, or ROA, which allows investors to use the current value of existing fund holdings plus new purchases to qualify for reduced charges. Both LOIs and ROAs make it easier for investors to grow within the same fund family without overpaying in fees. Now, not all funds have a front-end sales charge. Class A shares carry a front-end load. You pay when you buy. Class B shares have a deferred sales charge. You pay when you sell, typically declining each year you hold the fund. Class C shares usually have a level load, a small annual 12b-1 fee that's continuous but avoids the larger upfront cost. Speaking of 12b-1 fees, these are marketing and distribution expenses charged annually as a percentage of assets. A fund that charges more than 0.25% in 12b-1 fees cannot call itself a no-load fund. That's the difference between a true no-load fund, which only charges its NAV, and one with a small, ongoing marketing cost embedded in its expense ratio. Now, what's inside a mutual fund? It depends on its objective. A growth fund invests in stocks with strong potential for appreciation. An income fund targets dividends and interest, focusing on bonds and preferred stocks. A balanced fund mixes the two, offering moderate growth and income. A money market fund focuses on stability and liquidity, holding short-term debt like treasury bills and commercial paper. Each of these has its own role. A growth fund aims for long-term capital gains, while a money market fund aims simply to preserve capital. All mutual funds must distribute at least 90% of their net investment income to shareholders each year to avoid corporate income tax. That's the rule under Subchapter M of the Internal Revenue Code. This distribution requirement is what makes mutual funds regulated investment companies, or ICs. Investors then pay tax on those distributions, whether they're dividends, capital gains, or reinvested income, but the fund itself avoids double taxation. For exam purposes, remember that mutual fund shares are redeemable. They do not trade on an exchange and cannot be sold short. Redemption is always at the next calculated NAV, a process known as forward pricing. Orders placed before 4 p.m. receive that day's NAV. Those placed after receive the next day's. And there's a key difference between mutual funds and closed-end funds worth keeping front of mind. Mutual funds issue and redeem shares directly with the fund itself. Closed-end funds trade in the market, often at a premium or discount to NAV. If you see a question where the price of the fund is set by supply and demand, it's a closed-end fund. If it's redeemed by the issuer at NAV, it's an open-end mutual fund. There are also exchange-traded funds, or ETFs, which trade like stocks but track an index, blending the liquidity of an exchange-listed product with the diversification of a mutual fund. Some ETFs are structured as unit investment trusts, others as open-end funds that trade intraday. Either way, they've become one of the fastest-growing areas of the investment world. Investment companies represent one of the cleanest forms of collective investing ever designed, allowing ordinary investors to own diversified, professionally managed portfolios with as little as a few dollars at a time. For the Series 7, remember, NAV reflects value. POP reflects cost. The sales charge is the difference, and the structure of the fund determines whether shares are traded or redeemed. Investment companies are, in many ways, the foundation of American investing, built on diversification, accessibility, and the trust that comes from transparency. Next time, we'll look at variable contracts and insurance products, where investment meets protection and risk takes on a different shape entirely.